This morning, silver didn't just rise, it exploded. Not slowly and not politely. It jumped and erased the entire crash in one move. It smashed resistance like it wasn't even there. If you're watching this right now, you're late to the headlines, but early to the truth. Because what just happened has nothing to do with charts, RSI, or technical indicators. This move was driven by fear, power, and survival. And before we go any further, if you want clear, no-nonsense breakdowns of what's really happening inside global markets, subscribe to World Finance Decoded. We don't chase hype here, we decode it. Trust me, what you're about to hear is something most people won't understand until it's too late. Now look at the screen. Silver didn't just recover, it surged nearly $4 in a single session. The entire New Year's crash is gone. The resistance level that held it down for weeks was destroyed. This kind of move has a name in financial history. It's called a melt-up. And melt-ups don't start because investors feel optimistic. They start when markets realize they misunderstood reality. What you're seeing right now is not normal price discovery, it's panic repricing. And the reason is simple. The world just added a war premium back into the system. While markets were closed and traders were offline, a geopolitical shock hit. The United States launched a strategic military operation tied to Venezuela. Forget politics for a second, because markets don't care about speeches. Markets care about resources. Venezuela isn't just another country. It holds the largest proven oil reserves on the planet. The market remembers history, old quotes, and old intentions. When a superpower moves toward a resource-rich nation, markets don't debate motives. They price risk. The message was loud and clear: secure your resources or lose them. That single realization triggered an immediate global response. Money didn't rotate, it ran. It ran out of risk assets, out of bonds, and out of anything that relies on trust, stability, or peace. And it flowed into the only assets that don't require permission to exist during conflict. Gold absorbed some of it, silver absorbed the rest. Gold rose, but silver surged. That's because silver isn't just a safe haven. It's a strategic material. When the world moves closer to conflict, silver doesn't get one source of demand. It gets two. Monetary demand from fear and industrial demand from war. That combination is explosive. Here's something most people missed. This rally didn't start when New York opened. It started Sunday night, when global electronic markets came online. Silver didn't tick higher. It gapped higher instantly. That tells you smart money acted before confirmation. Smart money doesn't wait for analysts. It reads signals early and acts fast. They saw the headlines and understood what war does to commodities. They also knew silver has higher volatility than gold. So they hit the buy button all at once. And when thousands of buy orders hit a market with no sellers, price doesn't move smoothly. It teleports. This created a liquidity vacuum. No one wanted to be short silver with the US military active. No one wanted downside exposure when supply chains could fracture overnight. And that gap trapped bears instantly. Anyone who went home short on Friday woke up underwater. When shorts panic, they don't negotiate. They buy at any price. That forced buying didn't start the fire. It poured gasoline on it. Now, here's the deeper layer most commentators won't explain. Why does Venezuela matter to silver at all? Because Venezuela is a signal to every resource-producing nation. Mexico, Peru, and Chile are watching. These countries produce most of the world's silver. When one resource-rich nation becomes a target, others ask the same question. Are we next? That fear changes behavior immediately. Exports get restricted and stockpiles get hoarded. Payments get demanded in hard assets instead of paper. Mexico alone produces roughly a quarter of global silver. If even part of that supply locks up, the market breaks. Prices don't rise because of what has happened. They rise because of what might happen. That's what you're seeing now. A survival premium. This is why geopolitical moves are violent in markets. They're not about earnings or growth. They're about continuity. Now look at gold again. Gold is doing what it has done for thousands of years during conflict. It rises, but silver is outperforming. And there's a reason for that. Silver is a hybrid asset. It's money, metal, and a critical military input. Modern warfare doesn't run on steel alone. Missiles, satellites, drones, and communications all require silver. War doesn't reduce industrial demand for silver. It accelerates it. At the same moment investors rush in, governments step in as price-insensitive buyers. When they need silver, they don't wait for pullbacks. They pay whatever it costs. That creates a floor under the market. Suddenly, this isn't retail versus banks anymore. This is state-level demand. That's not a trade. That's a regime change in pricing. And while this is happening in the West, something bigger is happening quietly in the East. China isn't watching the war. China is buying metal. There's a massive price gap between Western paper prices and Asian physical prices. Instead of closing, that gap is widening. That tells you demand isn't being met. Silver is flowing east. Every ounce that leaves London or New York tightens supply in the West. This isn't speculation, it's logistics. Silver moves where it's valued most. Right now, Asia is setting the real price. That means the price on your screen is discounted. When physical markets diverge from paper markets, paper always loses. Always. And that divergence is still growing. Now the banks are trapped. They sold silver into weakness, expecting calm and time. Instead, they got war and China at the same moment. And the real squeeze hasn't even started yet. In the next part, headlines scream about war and spikes. The real damage is happening quietly inside vaults, balance sheets, and bank risk models. Over the last few weeks, major bullion banks believed they were in control. They thought the year-end smash worked and dumping silver below 71 reset the game. On paper, everything looked perfect and risk appeared reduced. But markets don't care about plans, they care about timing. While banks played accounting games, geopolitics and physical demand collided at once. When those two forces meet, paper models fail completely. Now price is back above 75, and that level matters deeply. It was the line holding the suppression structure together. Above 75, stop losses trigger and algorithms flip direction instantly. Short positions turn into liabilities instead of strategies. Risk systems don't ask opinions, they force action. And forced action in a rising market means buying. This creates chase buying where banks are no longer leading the move. Every dollar higher increases losses and pressure builds fast. The first bank to cover survives with less damage. The last bank to cover gets destroyed, so cooperation collapses. Instead of suppressing together, banks begin to cannibalize each other. One bank buys to survive, pushing price higher. That hurts the rest and forces them to buy too. This is how coordinated control breaks apart. At the same time, physical arbitrage is adding fuel to the fire. Silver is cheaper in New York than in Shanghai, which should not happen in a healthy market. Normally, traders would close that gap instantly, but instead, both prices are rising and the gap remains. That tells you demand is overwhelming supply. Silver is being pulled east and it doesn't come back. Every ounce leaving Western vaults weakens paper promises. This is real-time destocking, not theory. Factories in the East don't speculate, they consume. Solar panels, electronics, and energy infrastructure require constant supply. They buy even at higher prices because production must continue. That makes demand inelastic and breaks paper pricing. Meanwhile, massive call options above 75 are now in the money. Banks that sold those calls are forced to hedge. Hedging means buying futures, which pushes price higher. This creates a mathematical feedback loop known as a gamma squeeze. In past cycles, banks could dump physical metal to cool the market. That escape no longer exists because vaults are thin and refiners are tight. There's no hidden supply left to save paper pricing. Price can only rise until demand is rationed. This is why the move feels unstable and violent. A short squeeze without physical supply is the most dangerous condition in markets. It's unlimited money chasing limited metal. And the biggest money still hasn't arrived yet. Institutions move slower and deploy in January. Pension funds, endowments, and sovereign wealth allocate themes, not trades. Silver fits inflation protection and strategic materials perfectly. When they buy, they lock metal away for years. That permanently removes supply from the market. Every ounce bought now won't be available at higher prices later. This is why this cycle isn't like 2011. Back then, silver was abundant. Today, it's not. The market is where it used to be. January is not just another month on the calendar. It is allocation season. This is when the largest pools of capital on Earth move. Pension funds, university endowments, and sovereign wealth funds all reposition quietly. These aren't traders chasing momentum. These are allocators moving mountains. For decades, they followed one rule: 60% stocks and 40% bonds. That model worked in a world of low inflation and trust in central banks. That world no longer exists. Bonds no longer protect, and they lose value in real terms. Inflation eats fixed income alive over time. So the committees met quietly and methodically. The conclusion was unavoidable. They need hard assets, not for excitement, but for survival. Silver entered the conversation because of function, not speculation. Energy transition, infrastructure, defense, and technology all require silver. This is demand driven by necessity, not hype. Institutions don't buy coins or day trade futures. They buy exposure through ETFs and structured products. And this is where the pressure point forms. Every ETF inflow requires physical silver in a vault. Not promises, not paper, but real metal. That turns ETFs into vacuum cleaners for supply. Every large inflow creates immediate physical demand. So the question becomes simple. Where does that metal come from? London vaults are thin, COMEX inventories are stretched, and Shanghai is pulling supply east. There is no excess silver waiting on the sidelines. Banks scramble by bidding higher and calling refiners. They lease metal, pay premiums, and absorb rising costs. Each of these actions pushes price higher. Trader money is hot and moves quickly in and out. Institutional money is sticky and stays for years. When a pension fund allocates, that metal disappears from circulation. This creates a ratchet effect in price. Silver rises on buying but doesn't fall on selling. Because there is no selling, the available float shrinks every day. Markets don't break with explosions, but with quiet removal of supply. That is how structural stress builds. Fund managers are human, and they watch performance tables. They see silver outperforming bonds, equities, and expectations. Career pressure forces them to chase. Performance chasing turns disciplined allocators into momentum buyers. Momentum buyers don't wait for pullbacks. They buy confirmation. That pulls in quant funds and algorithms. They see improving Sharpe ratios and confirmed breakouts. And so leverage enters the system. Now fundamentals and technicals align. This is when markets accelerate, and it's happening while inflation remains stubborn. Energy prices are rising and shipping costs are up. Wages are sticky and the soft landing narrative is fading. Silver thrives in exactly this environment. It protects purchasing power, enables production, and stores value. Very few assets can do all three at once. That's why silver is being reclassified, not as a trade, but as a strategic metal. Once that mental shift happens, price targets change. 75 stops looking expensive and starts looking cheap. Pullbacks feel shallow because real buying appears on every dip. This buying is driven by need, not hope, and that changes market behavior. Liquidity is quietly disappearing from the silver market. Liquidity is not volume, but the ability to trade without moving price. That ability is fading fast. Bars are moving, vaults are draining, and supply chains are tightening. Future price moves will be faster and more violent. Less metal means less buffer. Volatility will increase and sharp drops will happen. Not because the bull market is over, but because weak hands are being shaken out. Leverage will be punished and margin traders will be liquidated. The metal will move into stronger hands, hands that do not sell. This is how secular bull markets mature. They don't climb stairs, they jump cliffs. That brings us to the final question. How do you survive this phase? Because surviving a bull market is harder than spotting one. The next part is about discipline. Lower current means thinner wires. Thinner wires mean less copper. Less copper means lighter vehicles and better performance. From a cost and efficiency perspective, it was brilliant. But physics always collects a price. When voltage goes up, electricity behaves differently. At higher voltage, electricity doesn't politely stay in its lane. It jumps. This is called arcing. When a switch opens at 48 volts, electricity can leap through the air like a tiny lightning bolt. That spark burns incredibly hot for a fraction of a second, and that heat destroys ordinary metals. Copper pits, brass welds shut, contacts fail. If this happens in a house, a light flickers. If this happens in a vehicle controlling steering or braking, people die. So Tesla faced a problem that could not be solved with software. It could not be solved with design tricks. It could only be solved with chemistry. There is only one metal that can reliably survive electrical arcing at scale. One metal that conducts heat fast enough. One metal whose oxide remains conductive instead of becoming an insulator. That metal is silver, not bars, not coins. Industrial silver alloys engineered specifically to absorb heat, suppress sparks, and keep circuits alive. Every button, every relay. Every safety-critical switch in a 48-volt system requires silver-based contacts. There is no substitute that works long-term. This is not about saving money. This is about preventing fires and system failure. And here's what most investors missed. Tesla didn't reduce metal usage. They upgraded metal quality, they removed pounds of copper, and replaced it with ounces of silver. Now pause for a moment and think about what Tesla really is. They are not vertical, logic disappears, and emotion takes control. Emotion has destroyed more portfolios than bad analysis ever could. Silver is no longer behaving like a normal asset. It is trading like a pressure valve ready to explode. Buyers are not entering for profit, but out of fear of being left behind. Fear-driven markets are powerful, but extremely unforgiving. This is where most investors make fatal mistakes. They over-leverage, chase green candles, and abandon their plans. Volatility then wipes them out without warning. A parabolic market never moves in a straight line. It surges hard, then pulls back sharply, then surges again even higher. These drops are not crashes. They are leverage cleansers. Banks know exactly where stop losses sit. Algorithms are designed to hunt weak hands during pullbacks. High leverage in silver right now is one of the most dangerous games in finance. One sharp move down can erase months of gains in minutes. Strength in this phase is not aggression, it is resilience. Fully paid positions outperform leveraged ones. Physical metal and low leverage exposure offer survival. You want to hold a position that does not force action during a 10% drop. The biggest gains go to those who cannot be shaken out. Exchange halts are now a real possibility. If the market freezes, panic is the worst response. A limit up halt is not bearish, it means there are no sellers. Price is searching for a level that does not yet exist. Selling during panic hands assets to disciplined investors. The correct move is patience. The next structural zone lies in the mid-80s. Between 75 and 85, resistance is thin and price can move fast. This does not mean straight up, it means violent movement. At 85, expect a fight. Profit taking, new shorts, and fear headlines will appear. That behavior is normal and healthy. What matters is how price behaves after arrival, not how fast it gets there. This is where real confirmation occurs. Structure matters more than speed. Never sell silver directly for dollars. A rising silver price signals a weakening dollar in real terms. Swaps, not exits, are the smart move. Rotate silver into gold or productive assets. Watch the gold to silver ratio closely. Bull markets end when that ratio compresses sharply. 30-1 is the first warning signal. 15-1 is the historical extreme. We are nowhere near those levels yet. Your plan must be written now, not later. Mania destroys clarity and invites mistakes. Discipline protects you from yourself. This move was triggered by geopolitical stress and safe haven demand. Physical silver is flowing east at premium prices. Banks are trapped and forced to chase strength. Options and algorithms are amplifying volatility. Institutional capital is entering slowly but relentlessly. Physical supply remains constrained. This is not a normal rally. It is a repricing of silver's role. Strategic, energy, defense, and monetary demand are converging. Markets do not reprice quietly. They reprice violently. Volatility is the cost of participation. This move will not end because silver feels expensive. It ends when demand collapses or supply returns. Neither has happened. If you understood this breakdown, you are already ahead. You are not reacting, you are thinking. That is the